Good evening, everyone. Thank you for joining us this evening. My name is Scott Lurie with F Street. I started F Street in 2009. We're having a brief technical difficulty, so the presentation we're going to run through tonight, we will be able to email you the entire presentation following this evening's presentation. If you have any direct questions at any time, please feel free to put those in the chat. We will answer all questions this evening. If there's any questions I'm not able to get to, for the sake of time, I will be responding to your questions offline and sharing those with the group as well. So thanks for joining us. As I said, my name is Scott Lurie. In 2009, I founded F Street with the idea and premise to create and continue to deliver alternative investments specifically focused in the real estate industry to investors such as yourself. I'm also joined this evening with Mitch Ferraro. Mitch, come on up for a quick second and say hello. Mitch is part of our investor relations team. You might have spoken to Mitch, or if you have any questions about anything we're doing here at F Street, Mitch is a great resource, as well as I'm always available for you. So feel free to join. Feel free to reach out to Mitch or myself at any time. Thanks, Mitch. So we talked a little bit about F Street. F Street's strategy is focused on alternative investments in the real estate category. Our goal is to deliver above market returns to all real estate investors of ours, focused on 3 different verticals. And so when I say 3 different verticals, what do we invest in F Street? We focus on what we're going to talk about this evening, which is our lending. It's our mainstay. It's our legacy fund. We've been lending money since 2009. We're going to talk a lot about our private debt fund, which is directly focused on lending. We also do build ground up industrial development throughout the greater Midwest region. And then we also have a vertical that focuses on multifamily. We build value add or buy value add, as well as build multifamily. And we've got some great projects. We just closed today on our project in West Bend. Our team has been working incredibly hard. We raised $11 million of equity and just closed on it. Construction starting next week. So we're really excited here at F Street, coming off of a recent closing today. And we can talk more about that. We're going to discuss mostly the private debt fund, which some of you might be familiar with as a promissory note fund. But we have changed its name, but all of the ingredients of it still remain the same. So private debt fund, and we're going to get into the behind the scenes. How can we pay 10%? How have you been paying 10% for 10 plus years, which is actually 15 years today? How have you been able to deliver these returns consistently to the investor pool? I'm going to walk you through the behind the scenes on how we have been so successful and so consistent in delivering our returns to our investors. So what happened? How did the debt fund ever even get created? I'm going to bring you back to a brief story in 2003. When I got involved in the real estate industry, I was with a group called Homevestors, the We Buy Ugly Houses folks. And I was really interested in buying ugly houses. I was really also interested in, most importantly, what they were doing with their line of credit. Homevestors was lending money to other real estate investors, which were their franchisee. And so, as part of that was, as I was learning how to be a real estate investor, I was also learning and watching what they were doing as it relates to lending, and I was very intrigued. In 2008, I left Homevestors and started F Street and our private promissory note or private debt fund in 2009. And so what I realized was there is a massive gap in the industry of people that are able to finance and fund fix and flip investors. So our business is really focused on fix and flip investors. We are 95% of our portfolio funds this very unique category of 1 to 4 family, and about 90% of our loans have a component of a repair to it. So some improvements are going to go into the property at some point to improve it, to allow the investor to exit our loan. Institutional limits, the Frank Dodd Act really was a big catalyst for what drove a huge demand for us. As banks continue to become more restrictive, we as a lending institution are more nimble than those banks, and we can be competitive in the industry. So we're still seeing today, a property just went on the market here in Milwaukee, Wisconsin. There are 7 cash offers for it. 3 of our clients wrote offers on that property. as a cash offer with using our fund. So we can close faster or equally to the cash offer buyer. So there's that void of time and timing and convenience. So demand still remains incredibly high. And then we've also been able to grow our promissory note fund or the private debt fund from $700,000 to approximately $90 million that we have in it today. So the vision and the growth. As I said, I started with $700,000. I had a couple buddies, college buddies that gave me some money. I put in some money. We started with $710,000 and we were off to the races. We wrote a bunch of loans, 1 or 2 loans a month, 1 or 2 loans a year for our first year as we were growing. We put the people and the process in place. I'm a big people and process person, and I started since 2009 building processes to understand what's important to our clients, the investor, the real estate investor, what's important to my investor, which is a timely, prompt, deliverable of payment, and then what's important to our team as we build to reduce our risk exposure. And so reducing our risk obviously allows us to be more profitable and continue to deliver these great returns. And then obviously with growth, we started as MilwaukeeHardMoney.com. We started in Milwaukee, Wisconsin. We now lend in probably 12 different states with a focus on 5 states: Wisconsin, Illinois, Indiana, Ohio, and Michigan. And we focus on creating greater penetration into those markets right now so we can continue to close what our goal is 100 loans a month of issuance. So the private debt fund, what is it? So the private debt fund is what we used to call a promissory note fund. It's where investors give us their money, we take their money, we lend it out to our clients, our investors, our real estate investors, our clients, and then we pay a return. And so in that return, F Street only lends money. So F Street Investments only lends money in the first position on real estate. So what does that really mean? We have the primary mortgage on every single home we lend money on. So in the event of a default, we have a piece of collateral that you or I can drive by and I can tell you what's going on with that property. So that is a very important piece of security that F Street does every single time. So we have no other product except a single first lien position on real estate. In addition to that, our loans are all short term. Our average payoff is 288 days today. It's been as low as in the low 200s. It's been as high as about 300. Our average is 288 days. And so our borrowers are borrowing money from us today, and in 288 days on average, our money is being repaid back to us. So short term, high interest rate loans, our borrowers are then exiting our loan and either selling the property. 50% of our clients do that. The other 50% keep these as rental properties. And the interesting part of the rental side is there's a new process which is really called value add, but a lot of people call it BRRRR, which is a process where people are buying houses, they're renovating them, they're renting them, they're refinancing them, and then repeat BRRRR. And if you look at the BRRRR strategy, the whole execution of BRRRR strategy is really contingent on a lender like F Street to go out and give them the initial capital, to give them the repair funds for the work that they're going to do to improve. What is the most important part of it is the after repaired value of the property so they can refinance. And in many cases, end up with 100% leverage on a property that's cash flowing $200, $300, $400, $500 a month, and that gives them the ability to then go do it again. And so we have clients that are doing 20 to 30 loans with us a year. That's 3 to 4 a month sometimes, and they're able to take our money, short-term, high-interest rate money, execute on their business plan, get it to a higher value, appraised, and then refinance through a DSCR loan or other traditional forms of financing. And it's an amazing process when you see the entire circle come together. We also have fix and flip people, investors that are buying a house today, and in 6 weeks from today, the house is completely remodeled, gutted, put back together and back on the market. And we're seeing tremendous profitability for that investor. And so they're seeing us as an opportunity to make money as the widget is part of maybe their raw goods or their cost of goods in terms of how they can continue to grow. So a lot of people ask, how does it work? What really happens? And so the promissory note fund or the private debt fund, and I'm going to use those just as interchangeable only because for the last 15 years, I've been calling it the promissory note fund, and now it's the private debt fund. So bear with me. It pays a consistent, steady 10% return. So when you invest in the private debt fund, your funds are earning 10%. They earn 10% for an annual basis every year. I've been paying the same rate since 2009, and our investors that invest with us love a lot of the attributes of this fund, which is on the last business day of every month, we make your distribution. It's 1/12 of 10%. So if you invested today, well, today's not a great day because tomorrow's the first, but if you invested on March 1st, on March 31st, the last business day of March, you will receive your first distribution. We pay you 1/12 of 10% every month while your funds are invested. So if you invested $120,000, you can expect to be paid every month $1,000 or annually $12,000. You do get a tax form from us. We have an unbelievable portal at fstreet.com. fstreet.com houses all of your information, including your tax forms, your subscription agreements, your promissory notes, any investments you have with us, as well as your K-1s if you're involved in any of our equity deals, or in this case, a promissory note deal, you get a 1099 INT. And the funds are tied up for an initial period of 1 year only. Now, we could tie them up for longer, but we don't. We tie them up for 1 year. We have a very liquid fund. And so we do request a 90-day callback when you want funds from F Street. And that's a two-way position where we can call your funds back within 90 days after the 1 year, or vice versa. You could ask us to repay you, and we can do that. Now, as a caveat to all of this, we do have from time to time investors that will call and say, hey, listen, I would like to have my funds withdrawn early. We do that as an accommodation without penalty every day. We've never not paid back an investor if they've asked for it early, but we do need to have some system in place to allow for a 12-month lockup period. But if you would or should need the capital you have invested with us, I will do everything in my power to get you your funds back as needed. Those situations sometimes become stressful for you. We want to make it not stressful. We appreciate your trust in F Street and what we're doing here. So we will, in the unlikely event, get you your funds back. I do want to also mention that we do have, after the 12 months, we do have a 95% retention rate. So 95% of our investors are adding or staying with F Street after the first year. So the fund benefits. So we've consistently paid out. F Street has never missed a monthly payment in 15 years. So for 15 years, my track record is on the last business day of every single month, I have made our distributions to our private debt investors at 1/12 of 10% for the last 15 years. That is true. That is true and accurate. We've never missed a payment. We continue to see huge demand. Right now, we're averaging about 300 to 330 applications a month. And we're closing on those at about a 13 to 15% close ratio. Our goal right now is to close 50 to 60 loans a month. And our long-term goal by the end of 2024 to close 100 loans a month. And so our average loan is $150,000 or thereabouts. For investors looking to avoid long market volatility, you get immediate returns. The market's crazy. We all know that. We also know that the world's crazy and getting crazier. We've got great, steady, consistent returns. If you're not earning 10% on your money, ask yourself why. Ask yourself, how do I get involved in F Street? And if you go to fstreet.com, you will be able to get invested immediately. And then monthly returns are also delivered on a monthly basis so that you can help manage your cash needs or your life requirement. I have a lot of investors that are in their middle 50s or early 60s that are looking to backfill their investment with F Street for their lifestyle. I spend $10,000 a month on something. I want to give F Street $1.2 million so they deliver me $10,000 a month. And we've got a lot of those folks in our fund. And we deliver $10,000 a month to that individual, and they use those funds to not chip away at any of their savings, but to spend it on their lifestyle that they want. We have that all the time. So how do we get our customers? Where do people come from? How do we even know it? So we have two facing businesses. fstreet.com, or F Street brand, is our investor facing brand. We focus on our investor under fstreet.com. Our clients, that are coming to borrow money from us go to thehardmoneyco.com, thehardmoneyco.com. So there's the URL, thehardmoneyco.com. If you go to thehardmoneyco.com, you will see all of our process in place. Our website is an unbelievable resource, as well as a complete vehicle for anyone to do, for an investor to do anything they want on and I mean a real estate investor do anything they want. They can put in a loan application and they can request funds, they can submit a scope of work, they can ask for a payoff, and they can request to contact us.
We have a question.
Yes. So yeah, great question. Thank you for asking it. F Street, I was privileged to attend the George Washington University, where I lived in Washington, D.C. I lived on F Street. And so I got creative as I graduated, was looking for a name for my company. My college roommate, best friend, Andrew Dreckerman, said, let's call it F Street. I said, okay, F Street. And F Street was created. So it came out of the Washington, D.C. area, and was great fond memories there. So always fun to tell the F Street story. A little bit about our loans, as we said. So most of our loans are for flipping, right? They're doing something. Funds are real estate investors are to renovate homes. We average, which we'll get into, about 100 repair draws a month. All of our properties, all of our loans are secured by the collateral, which is real estate. Now, if you own a stock, you got a stock certificate maybe, or you've got something on your Charles Schwab or E-Trade or whatever you use. In our world, I've got a physical address with several assurances. I always have property insurance, I have title insurance, and I have some real property on that piece of parcel that I've lent money on, and that security is really important to us. First lien position. Our loans are capped at 65% of the property's after repaired value. So we use ARV a lot. Did I shift this too much? Sorry. So we use ARV a lot, which is the after repaired value. And so we lend up to 65% of that. And in our portfolio today, if you were to invest with us today as a new investor, your investment is diversified across all of our loans. We have about 585 loans in the portfolio today. Your investment is spread across our entire platform. And so if you invest today, you don't have the risk of one loan going bad or two loans going bad, or you're involved in one loan and you, as an investor who are mostly passive in nature, are looking for us to diversify for you. You're diversified across everything. You want me to do this?
Yep, attention.
How much more?
That's it.
Okay, sorry about that. My hands got away from me on that. So you're diversified across all of our almost 600 loans, and when you come to invest with F Street, you're invested across this entire platform. So 123 Main Street in Milwaukee and 123 Main Street in Chicago might be in your portfolio of our loans, and you are just collecting 10%. So a little bit about our business structure. How do we get clients? How do we do everything here at F Street? So this is a great example of basically how we operate, right? So we start with the marketing, right? So we're spending money, and how do we solicit our clients? We start spending money through Google AdWords and Facebook and other social platforms to get back onto our platform. We also average about 50% repeat customers every month. So once you become a customer of F Streets or the Hard Money Co's, once you're a customer, we traditionally have 50% of our loans that we issue every month are from a repeat customer. Once it goes in, a loan application comes in, we get into our underwriting department. We've got an underwriting team that have our senior veterans in the industry that underwrite our risk to make sure it's the right risk we want to issue. We close only about 15% of the applications we get in a month. So if you think we're getting 300 applications, we're denying a large percentage of those. We go through our processing. This is the title. This is titling and all of the legal documents that allow us to encumber the property. And then we go to originations. It's when we fund the transaction and the borrower brings money to closing. Every single deal we have, the borrower has skin in the game. It is the biggest and most important part of, I think, our recipe for success is that we require the borrowers to have skin in the game. There is no such thing as a get-rich-quick scheme in real estate, in my opinion, and you can't get rich quick with F Street's lending without bringing money to the deal. If you're a new borrower, you are bringing 20% down, plus fees. If you are a repeat borrower, you're bringing 10% down. Regardless, you're bringing money down. In addition to that, if you have collateral, which we have a lot of our borrowers have free and clear real estate. So they own 123 Main Street and 1234 Main Street. And we take those two properties, and in exchange for the down payment, we'll encumber another property. We also go through the repair draw process. As I said, about 90% of our loans have repair draws to them, which means that somebody has repair funds held with F Street to do something to a property. When we go through the underwriting, we're getting what we call a scope of work, which details what work they're going to do to a property. When they ask for the repair funds, we only pay on finished work. This is also a very important piece to our success. We only pay on the finished work. So if somebody says, I want to go put a roof on it, when the roof's installed, we will pay them. We pay them within 24 hours after inspection, but it has to be completed. So we only pay on finished work. Believe it or not, people will order windows for this house and put them into that house. So we only pay on completed work. And then we have the servicing, right? The fun part. We got to get the collections. We got to get their monthly payments in the door. We have to get their tax escrows paid. Then they want to request, meaning the borrower wants to request a payoff or a statement or any of the different things. Our servicing team is there to handle that entire process for them. That also includes collections. We do have borrowers as part of the lending process that do end up in collections, and our collections teams does work with them to make sure that they pay. Every single day we're on the phone with our borrowers, making sure their projects are moving along and that they're paying their bills. And then in the event that we do take back a property, we took back 2.23% of our loans last year as REO, and we've disposed of them all. So we have an REO management, which is real estate owned. REO stands for real estate owned management. When it comes back to F Street, we dispose of it. I'm very proud to say in the last 5 years, which we've been really tracking, the REO management has been a profit center for F Street. So we've taken back properties and we've been able to make money on them because I have which I probably didn't tell you when I started with Homevestors, I flipped 150 houses. So flipping a house is about running like a bull, running through the process to make sure that the process is done and everything is completed and you can sell it as fast as possible. I've got great experience doing that, and so our REO management is a profit center for us today. Yeah, so the question is, will we fund if somebody else is taking out a secondary position? The answer is yes. It happens more often than you think. We would prefer, so what happens sometimes, just to let you know, before we issue the first mortgage, their funds are coming from John Smith. John Smith won't tell us at the time who he gave the funds from, but then John Smith will encumber the property as a subordinate position. So long as I'm in the first lien position, there's never been a problem. People get a little bit confused about what that really means. In the event that we were to take back a property in foreclosure, which means we file a foreclosure action, anybody on the chain of title has to be served. And so this adds another person to that chain of title in exchange for maybe you could take a DIL or a deed in lieu of foreclosure. The risk there is so low after the 15 years I've been doing this, it's never been a material problem. So yes, we will do that. It does happen and we are part of that all the time.
We have another question. Can you tell?
Yeah, so we're going to talk about that in the next 2 slides, if that's okay, if I defer that question until we get there. Someone asked a question about how is the capital stack and how does the investor protected by our, meaning the ownership's war chest of dollars that are on our balance sheet, and I'm going to talk to you about that in 2 minutes. So great question. So marketing and lead generation, we spend a lot of time and energy here, right? Our goal is to get to 50% repeat borrowers every month and 50% new clients. And of the new clients, we are hoping to get those clients to have at least 3 transactions of experience done. Now, that's the perfect scenario. So we're out every day trying to create digital engagement with borrowers, people that are in this industry. This industry has grown tremendously over the last decade, but we're trying to get to the right borrowers that have the experience. and the knowledge and the capital to be successful. And so we're out finding them. We get about 300 applications a month, and we close about 15% of those. So we're fighting the fight through Google and the social platforms. We do a really good job communicating. It's a very important value of the companies, is that everybody gets a response, everyone gets communicated with. Our workflows and our communication to the client coming in, I think is best in class, and that's really important to me. Comprehensive underwriting. So it's very important. The most important part of it is this piece right here is underwriting. So we only lend on 65% of the after repair value. We only lend in markets where we have a tremendous amount of comparable set. And how do you have a tremendous amount of comparable set? Where there's a lot of action. So in an urban market, in Milwaukee, in Cleveland, in Detroit, in Illinois, specifically Chicago, there are a lot of transactions that are happening every single day. Those transactions, when they're arm's length, meaning they're from a willing buyer and a willing seller that are unrelated, those parties create the market, and that market is what we use to underwrite. We have phenomenal different tools. We have desktop tools that allow us to dial in to know everything about this property. There's so much data and pictures and various different data points that we're able to get to right from our computer that allows us to be really nimble and create very good ARVs. And this is really important to us. And this is why over the last 5 years, we've been really successful when we've had to take back a property that we're not running into losses. And then we obviously continue to manage our ARV process during the entire process of originating this loan through all of the resources from underwriting to property valuation to then back. Underwriting is looking at property valuation to determine what the actual ARV of the property is. Looking at our process and due diligence. So processing ensures that each deal is viable. We require with title that we always are in the first lien position. That is a closing instruction to the title company. That means that I'm going to issue a mortgage to you, and the title company, XY title company, is going to guarantee by insurance, through title insurance, that my mortgage is in the senior position. And so a lot of this, I've been fortunate to have very few title claims, but when we've had them, they've all worked out in our favor. We've had probably 5 in the last 10 years. So it's very low, but title insurance is a very important piece of what we do. We do also make sure that all of our borrowers are signing and have full disclosure into our loan through a loan disclosure, through an online process where they're getting their loan disclosures, they're understanding how much cash they have to bring to closing, they're understanding their obligations under their loan, they're understanding their property tax escrow and their insurance escrow, and then they're signing that and bringing those funds to closing. So our processing is a phenomenal, it's been a phenomenal work in progress. So here's the sauce, guys. Everyone says, well, how do you pay me 10%? I get it. But I get it because let me tell you how. We charge our borrowers 15% interest only. If you remember, most of our borrowers are with us for under a year, 288 days. So on a loan, if you were to take a $100,000 loan and you took an 8% interest rate, which is today's market, versus ours, they're paying about $7,000 of additional interest to F Street than they would to a potentially, if possible and viable, regular market. I can move much faster than Chase Bank or any other bank that's out there. So for $7,000, they're coming to F Street and saying, I'm willing to spend more money with you because you're going to deliver on the closing that's got to happen in 4 days. And I'm going to say, yes, I am. And we do that every time. Our original term is 6 months. So every term that we issue out is a 6-month loan. And in the event that they needed to extend, they would pay another origination fee. So we do charge 5% origination. So it's 5% origination, 15% interest. Loan origination works through all of our loan applications come in through what we call HubSpot. HubSpot is our CRM. Our HubSpot then talks two-way with our mortgage software, which is Mortgage Automator. Our origination team walks in every morning. They see all of the applications that are in the process of new applications, and they start dialing. Hey, what are you doing? This looks like a great application. Oh, you're a repeat borrower. let's move you through the process a lot faster. If it's a new borrower, I've got to update all of their information. One thing I might have not mentioned, which is very important, we do not lend to any consumers. So every one of our entities, every one of our borrowers is an entity with a personal guarantee behind it. We only lend money to corporations, LLCs, and corps. We don't mind care what it is. It has to be something other than an individual's name, and we require the members of those entities to sign a personal guarantee with us. Repair draws. This is one of the biggest opportunities that we see every single month. I love our repair draws because we get to do one really important thing every month: talk to our investor. I get to get an update on their project. I get to see the quality of their work. How do we do all of that? So when a borrower submits a loan application to us, they submit what they call a scope of work. This traditionally details all of the repairs they're going to do to the property. They're going to put new windows in. They're going to install a new kitchen. They're going to maybe pour a new concrete slab, maybe do a garage, maybe install a roof. There's a wide variety of various things that they're going to do. Once we get that, and it's approved by our underwriting, that's what they're going to be asking for funds off of. The repair management, the escrow comes in as the final value of that number, repairs, plus the after repair value never can exceed 65%. When a borrower calls us and says, hey, F Street, I'd like to draw down because I just completed my roof, they'll submit what they call a repair draw. That draw costs the borrowers $200. The fee covers two things. One is it covers so that they're not asking for a repair for every door they're hanging. But the second thing is that we have a verification process that the work's done. What we've used is a very advanced process called TruePix. TruePix is a geo-specific service where we send them a link and they can take a picture, they can forward the link to their contractors, but the pictures have to be taken at the property. And if they're not taken at the property, or if they're taken of anything but the home, so let's just say they're taking a picture of a picture, the technology knows it's no good. And so we get a report back after they send us the link, we verify it and make sure that the work that they have provided is completed. Once it's been verified and completed, we issue out their repairs, their repair draw, or whatever they've asked for via ACH, whether it's same day or overnight. My job on the repairs and the repair draws is to get them their money as fast as possible to keep their project moving. So we do about 100 to 120 a month. Last year we did $17 million in repair draws. When the borrower gets started, I advance them $3,000 to get started on the project. So the first question is, do we charge 15% as an annual percentage rate on the loan? The answer is yes. We charge 15% interest, simple interest, divisible over a per diem of 365 or 360 gets you to the number. So yes, we do charge that on an annual basis. Hard money lenders all over the country do several different things. There are a million competitors of ours. Some of them charge 2 and 12, 3 and 12, 1 and 15. I just saw one that charges 0 and 22. We are probably at the highest level of interest in the industry, but probably tied to a level where we're high for sure on what we're charging by the annual percentage after fees. It all breaks down a little differently. The question is, how does that happen? How can we charge so much more than someone in New Jersey or the tri-state area? And the answer is because we're not in New Jersey and the tri-state area, and we're not fighting for those same customers. So we source our own customers. We have 50% repeat customers. Our process is better. And of the people that are charging the 2 and the 12 or the 3 and the 13, the industry has a lot of different people that either broker deals or they write on someone else's paper under what they call a white label. So F Street might not really be a balance sheet lender. I might be writing on constructive BPL's loan paper, and then they actually take it. I take the origination fee and then get a yield spread on the back end. We balance sheet everything. We table fund and balance sheet and service our entire portfolio. So we get everything that comes in. And so the question then is, how do we do it? And the answer is, we have a niche. Our average loan's 150,000. Those folks, our average loans are probably $400,000 or $500,000. We average we play in the Midwest. We do loans all over the country, but we do play in the Midwest, as 99% of the loans are issued here. And we have a really good niche in this $150,000 average space. And it works out really well for us. So we know all of the competitors, we see all of the data, we subscribe to all the data sources, we see all the other terms that they're providing, but we feel like our widget is just a little bit better for this very specific investor, and as a result of that, we're able to continue to close 40 to 50 loans a month. We did 500, almost 500 loans last year. Servicing and payouts. So how does this happen? People go to our website. We get payouts every single day. We've got 88 payoffs pending. About 30 of those pay off every month, 30 to 50, and that changes based on market. You go to the website. If you want to get a payoff, you submit a payoff request. Within 24 hours, we'll issue you a payoff. Every month, our servicing team collects. We only collect via ACH or wire for our monthly payments. Every month, we're taking payments and managing the collection process. In the event that someone does go past the 6 month and is in the extension phase, we do work on a payment plan on the extension, whether it's a pay up front, pay over the next 3 months. We do have some flexibility on the extension payment, as that is a fee that's earned, but we do work through that process. Collections. So people ask, what does it look like and how does it happen? Well, we're on the phone every single day. So we monitor our clients. All of our calls are recorded here through HubSpot. All of our collections team is working every single day to collect funds from borrowers, whether they've missed a payment, they bounced the payment, they need to pay one of their extension fees, they want to pay a little bit down on their mortgage. We have an entire team that works on this on a real-time solution. Every single day, we're talking to 30 to 40 different people that have different elements of something related to service and collections. And sometimes it's, hey, my tax escrow needs to be brought up. That takes 25 minutes of conversation with folks. So our collections and servicing team does an amazing job. We're on the phones all day long, and they do a really great job making sure that our collections remain high. So people ask, what is the terrible, no good, very bad day of foreclosure look like? And I'll tell you, when I first bought my first rental property in 2005, and the person didn't pay me rent, I couldn't believe it. I went home, I was dumbfounded. I'm like, this person's not paying me rent, and I have to evict you. Fast forward 15 years in the lending business. A foreclosure is a business decision for us. We foreclose. Of the foreclosures that we issue, I'd say 50% of them end up in some form of actual foreclosure, and the other 50% actually end up in someone paying us off or refinancing, or mother comes in and saves the day, or a forbearance agreement occurs and they end up paying us off. There's so much that happens in this world. The biggest thing a foreclosure does is it gets someone's attention. A process server knocks on their door. Hello, Mr. or Mrs. Smith. I want to let you know that I'm here to serve you papers for your foreclosure with F Street. Foreclosure, and I'm giving you a real life story. There's a lady in South St. Louis we wrote a loan for. We foreclosed on her because she wasn't calling us back. We called her and said, well, we kept calling her, no response. I issued her a foreclosure, and guess what happened? You got it. She called us the next day in tears. Why would you foreclose? I don't get it. My response is, well, why would you answer your phone? And why are we in this scenario? Fast forward, she didn't bring her account current. The house is now on the market for sale. She's going to make $200,000. I couldn't be happier for her. I'm sorry we had to spend the $3,400 on legal, but she gets to pay that as well. So how does the process work? We're only in the first lien position. We order a foreclosure commitment, which would be listing all of those parties I mentioned earlier that might or might not be on title, and we'll issue them a summons and complaint. When we do take back the property, we use a third party to go out and rekey the property. We take pictures every single month of the property. We manage the asset through the entire foreclosure process, as well as then when it becomes an REO process. Once we take the property back, we're in disposition mode immediately. What does that mean? I'm always looking under here for the most profitable way to dispose of the asset. That might include us finishing a home. We had a borrower in Illinois who started to build a house, couldn't finish it. we're finishing it right now. We originally had a value of $700,000 to sell it. The agent just told me today that she thinks we're gonna be able to sell it for $989,000. Another $289,000 that we never thought about. So we will look for the highest and best way to dispose of the asset to protect ourselves. And that's the very important part of F Street and our REO profitability. So we asked about this war chest, and I use the word war chest because it's a really interesting analogy of what actually happens. And so the business of F Street is really grown off of our need for capital when I first got started. So I would leave all of our profits in the business as I was trying to grow our balance sheet. Well, the nice part about that is today that balance sheet has about $11.5 million of our profits over the last 15 years sitting there that sits as a war chest above your investment. And so what does that mean? It's kind of hard to explain, but I'm going to try my best to explain it to everyone. Our capital source starts with our lender, which is CIT. We have $37 million from our investors, such as yourself, or what you're considering investing in today. And then the ownership, myself, has about $11.5 million on our balance sheet to protect all of our investors. And this started when my mom gave me some money, or my dad gave me some money, or my sister gave me some money. I always want to make sure I always could pay them back and make our payments. So we created this war chest that was at one point a couple $100,000 that has grown every year and continues to grow every year. We leave 50% of the profits of the business inside of it to grow this war chest. So if you think about our average loan over the last 5 years, the last 5 years, I've never lost money in a given month. Well, I've never lost money in a given month, so we're profitable. It's fun to invest with people that are profitable. That's a good feeling for you as the investor. We're always have been profitable. In addition to that, on our REOs, the ones we've taken back, we've made money. We've made money on all of those transactions. So I have lost on a particular property, yes, that's for sure. But in the given year span, over the good and the bad, I've always made money. And so the goal is that as I've made money, I've built this war chest up. So if our average loan is $150,000, and I've got $11 million, or let's just say $11.5 million in the account, we would have to have a lot of loans, specifically 100, go bad, which has never happened. And those loans would have to go from $150,000 of loan to zero. So it has to go from $11.5 million of loan value to zero. It would have to go down to $0, meaning the house would have to disappear and go away. And we would have to get $0 back from those. And then there is risk to an investor, right? We're a business, it's an investment. Like you invest in GE or Apple or whatever, you would invest in. Apple has, excuse me, I don't know how many billion in cash. We've got $11.5 million in front of us to protect you. That is so important because that number A is growing, and B, the likelihood that us losing on a given property or a given year has never happened in 15 years on the aggregate. And so you should feel really comfortable as we continue to grow our war chest that your investment with F Street is safe. So our foreclosure rate in 2023 was 2.23% of REO back to us. We have default that ranges anywhere from 6 to 12%. Sometimes it spikes, into the 15% range, and then it just comes back down. It just depends on the ebb and flow of the world. But non-payment is a different category than default, foreclosure, non-communication, no exit plan in place. Our results have been really good. We've had years where we've made several hundreds of thousands of dollars on our REOs, and we've had years where we've broken even. There has not been a year when we've lost money. So that's equally as important. Excuse me. The last important question is the black swan event, right? What happens? Our business really drives off of the black swan events, right? When the market crashes, what happens? The opportunity for real estate investors go up, and so long as the default rate is not driven off of what was in 08, for example, artificial appraised values that were driving to lending money to people that never ever should have been able to get a loan on a house that really was worth 50,000 but appraised at 180,000. That event never will happen here because we don't do or use third party. What does happen in a black swan event or in the peak valleys of the different cycles is we get a lot busier as the banks, the big banks, are clearing through their foreclosures through the homeowners, right? Homeowners start defaulting, great. So a lot of people locked into these 30-year rate mortgages or 15-year rate mortgages at 2 or 3, 4%. As those come offline and then reset to 7, 8, or 9%, will we see something happen there? Yeah, I don't know if we're going to stay in this cycle to actually see that negative black swan cycle come together, but who knows? We do hopefully see some leveling off in the 30-year mortgage, somewhere in the mid 5s at some point in 2025. But who knows if that actually happens? The housing market is odd right now. There's still demand. The demand for housing exceeds the supply. It's quite simply, when someone puts a house on the market, we're getting 3 to 5 offers still. We hear from our investors every day. I put it on the market. It's been on the market for 6 hours. I already got 2 offers. I went to go look at a house yesterday. We looked at it at 5 o'clock. We called this morning. There are 6 offers on the house. The demand for housing is off the charts. And in our case, with a $150,000 average loan and the ARV in the, call it the $300,000 range, we still are in the affordable housing, the largest category of housing, affordable housing needs. And so I remain incredibly, I would say, bullish about what we're continuing to do here at F Street and the demand that we're seeing. Our goal remains to grow our portfolio and our balance sheet to $200 million, and we're in the process of doing that right now. So I still see tons of demand. I don't see the black swan event equaling to what we all remember, the last incredibly terrible experience of the mortgage crisis, which was a inflated New York Stock Exchange CMBS market that just blew up on everybody. I don't see that being this incident, the scenario that happens next for us. We talked a little bit about some of our tools. We do have some really great cutting edge tools. We do have TruePics, which allows us to take pictures or have our investors take pictures for us. Our desktop ARVs, or our desktop appraisal softwares that we're using, is unbelievable. The technology has come so far advanced where you can see pictures, you can add square footage, remove square footage, add values, understand scoring. It's an unbelievable system right now. Our industry is still in its infancy. Private lending is still in its infancy. I think you will see at some point consolidation where banks will be interested in what we're doing, but they won't be through their process because the Frank-Dodd Act has taken everything away. Even getting a loan for a large deal under the KYC and all of the new guidelines underneath the federal banking laws are just very, very intrusive and take a tremendous amount of time. I got the greatest team in America. I feel great about everyone that's on this team. I've built this team over the last 15 years. When you come to work at F Street, I hope you're here for life. We have an amazing culture. I've got an amazing group of team members that are all focused on everyone's success. We're all rowing in the same direction every single day. We've got 30 people focused on the lending business. We're focused on being successful in this business, and everybody is rowing down that path to make sure that we're all successful. Any questions? Before I get into one other quick F Street, are there any other questions about the private debt fund at this point? I'd love to answer any questions. That's what we're here to talk about today. I do have a little bit of a plug for the remaining part of F Street, which I'd love to just share with you quickly, and I'll run through those to be respectful of your time. But are there any other questions I can answer right now? So I do see the demand. The demand is going to come in 2 ways. Geographical expansion for us is going to happen. The $200 million is going to come. So right now we're on target to raise $2 million a month, which is $24 million this year. Our first month we came up a little bit short, but we're making great progress because we see tons of investors interested in 10%. Once they get past the concept of how does that happen, and they learn how we do what we do, then they get really comfortable. And people, today, one of our investors invested 200 grand a month ago and just put another 200 in today after he got his first distribution. Once you get comfortable with what we're doing and you get comfortable with our team, we're 100% accessible. You're going to love your investment in F Street. The demand will come from growth, right? So we're in basically 3 or 4 states right now with penetration. We're going to get to probably 8 to 12 states with penetration. So yes, Oklahoma has a market. Yes, Indiana has markets. We're going to get into those markets where we can continue to penetrate and do 20 to 25 loans a market. 20, 25 loans a market gets us closing about 150 loans a month. That's a $200 million balance sheet. So yes, absolutely. The rest of the money will be coming from our lenders as we continue to grow our portfolio. So we will do 2 different things to get to the overall $200 million goal, which might be in 25, might be in 26, might be in 27.
Not considering future growth.
No. Well,
Answer the question.
the question is, at this point, is there any influx of money? Meaning, would an investor, if someone offered to make an investment in F Street, would we pare back any sizable investment? The answer is no. We have a credit facility that we throttle our investors with. And so if somebody were to come in and say, I want to put in $1 million, $2 million, $5 million into F Street, we would take those funds and we'd pay down our credit facility. And so that's how we're able to throttle them. If someone came in and said, I'm going to give you $100 million today, the answer is, can we sit down and talk, please, so I can execute on the business plan of starting our growth expansion into other markets? And we might want to take the $100 million in smaller increments, yes. But in general discussions right now, we are looking to take in $24 million during this year and to continue to grow our expansion and penetration into the markets. So I believe that we can close 30 to 40 loans a month in the Detroit market. I believe we can close 20 to 30 loans in the Milwaukee market. I believe we can close 30 to 50 loans in the Illinois market. Right now, we're averaging about 40 to 50 loans aggregate. So we're working towards that. Penetration, additional ad spend, get our name out there to get to where we're going, to get more penetration. We would love to consider your investment. And thank you for asking that question. If you are the $100 million investor we've been waiting for, I'd love to speak to you. So we do not allow for reinvestment or what you would describe as compound interest. The SEC, does not look favorably on compounding interest, and neither do we. So we pay out your investment. If you'd like to make additional investment on the quarterly basis, that'd be up to you. So yes, if you put 120 in, you will get distribution every month of $1,000. How you choose to reinvest that is up to you at your sole discretion. I did mention we do advertise. We are under the 506C general solicitation with the SEC. What that means is when you first become an F Street investor, you are required to get accredited on a third party. Our software does everything for you, but it is third party required. That is our federal government's laws. We follow those laws. You will go through a quick accreditation. You have to produce, as an individual, $200,000 of salary, or as a family, $300,000 of family income, or have $1 million of net worth that you can verify to a third-party accreditor. We use parallel markets. If you already have an accreditation letter that's valid, it's valid for 5 years. We're happy to just upload you in our system with that accreditation letter. If you have additional investors, the answer is yes. Please give us a call and let's discuss that. Mitch Ferraro is happy to discuss it with you. I'm also equally happy to discuss that with you. The answer is absolutely. Question is there any indirect or direct risk with the private debt fund and commercial paper getting called in the next few years? I apologize, I don't know the context of the question. I don't want to run on a tangent with it. If you could just elaborate in the chat, then I'm happy to answer that question. If you asked it and you'd like to have a one-on-one with me, I'm available.
In relation to property values.
in relation. So, in relation to property values, we play in the 1 to 4 family, single family market. 95% of our loans are in that market. To answer the question, I do think there's going to be a retraction. There's a disconnect. I see it coming very heavily in the big urban markets that have tons of vacant office space. What are these office buildings going to do? The walls can't pay rent, and there's hundreds of millions of square feet in our country that are going to remain vacant. Some people are converting them, but I think that is going to be the biggest implosion in the debt market. If you're holding debt on a commercial office building that's 30% occupied, you're never going to meet covenants. You're going to be in default. It's a question of when does the lender want to rip the Band-Aid off. As far as the housing market goes, which we'll talk in a brief minute, we just built a beautiful 199 unit apartment complex. We're leasing up. Our demand is unbelievable. We're seeing great demand for need for housing. So I don't see it happening in the multifamily space, quite honestly. And we have a shortage of 4 million housing units. So there's demand that's happening. There's a slowdown right now because there's a lot of new starts in multifamily. So there'll be a lag in about 18 months when those traditionally would have come online. But the lag is temporary at the end of the day. So I don't see that playing into our market specifically. And more specifically, the demand for housing remains incredibly high today. Yes. We're at 7 o'clock. If I understand everyone, I want to be respectful of everyone's time. If you want to drop off, feel free to do so. I'm going to run us briefly through a few other slides on some of our upcoming pending multifamily and other industrial projects that we have available in our development pipeline as part of fstreet.com. I also have some of our current investors on tonight. Thank you for being here. Your testimonials are always important to other investors. If you've made any referrals or if I didn't answer any of your questions tonight, or if you have more questions now, I'd love to talk to you. Please feel free to reach out to me. You have my cell phone number, I'm sure. So please do so. We do have referrals. If you are considering an investment with F Street, I have references that you can pick from to call and discuss with. So please do so. If anybody wants one of our cool new hats, bullish, our logo is the bull. I'd love to send you one of these. If you want to log on to fstreet.com and create a free account, I'm happy to send you one of these, or you can shoot myself or Mitch an email, and we'll get one sent out to you. A little cool swag for everyone. Thank you all for being here. I'm going to run through a little bit of the pipeline. We just closed on West Bend today. We're targeting a 2.6 time multiplier. I've got $500,000 remaining in this investment of $11.3 million. We've raised almost $11.3 million. I'm short $500,000, which we're going to raise over the next month. If you would like to invest, we've got 5 units left of funds. We close construction starting the next week. This is an unbelievable development in West Bend, Wisconsin. Construction's only 10 to 13 months because it's garden style apartments. Please consider an investment in that. Coming soon at Oak Creek, we're building 66 acres. We've already built all of this already. This is already done. We've got another 132 units coming with a $40 million development cost, raising about $14 million on this investment. The investment should open at the end of Q1. River Point District in La Crosse, we're so close to getting started in La Crosse as well. Beautiful master plan development. We're building 164 units there at a development cost of about $50 million. Around here, we just knocked down some really old, rundown, dilapidated, unused, vacant for 15 years office buildings. We cleared the site. Those just got knocked down at the end of December. We're in pre-development status right now. We will break ground on this project in 2024. It'll be about 150 units of garden style apartments. We're really excited about this. We have a project we built across the street that's doing incredibly well. And in Janesville, we're almost there with Janesville, building another 125 units right on the water. Really great, exciting site. Janesville, Wisconsin, up and coming market, great leadership, working hard to do a lot of great things in Janesville. Please follow us at fstreet.com. And then Southport, We've built in Southport, we've already built 1 million square feet of industrial. We've got 2 additional buildings to get started on, building 4 and building 6. That'll be another 500,000 square feet of industrial. This is phase 4. It'll be 250,000 square feet and about $20.5 million of development cost. This is coming, we're in pre-development right now, and it'll be coming towards the end of this year if industrial is interesting to you. This is forthcoming. This has been an unbelievable development for us, and we really love the Appleton market. So we talked about subscription and how to get to know more about us. Please visit fstreet.com. fstreet.com, log in, create an account. It's free. If you want to go through the accreditation, it's free. If you want to learn more about what we're doing, it's free. Join our site. You don't have to invest, although I encourage you to. But if you want to continue to stay in touch with us, log in, create an account, get your accreditation, be ready to go, invest whenever you're ready. Earn your badge. This is the accreditation badge. This is a badge that Parallel Markets will provide you, which is a certificate that you are accredited. You are accredited by a third party. You then qualify to invest in every one of F Street's deals under the 506C and anyone else's deals that's asking for a third party accreditation. Jump on in. It's free. F Street pays for your accreditation. Come on in and get accredited. Get your badge. You'll probably get some cool swag from us, including this bullish hat. I got some great t-shirts. Love to have you involved in what we're doing. Please consider investing with F Street. Thank you for your time this evening. Let's invest together. I'm available anytime. Feel free to reach out to me or anyone on my team. We pride ourselves on making sure that we call you and we call you back. We'd love to hear from you. All right, guys. From Milwaukee, thank you so much for being with us this evening. Once again, my name is Scott Lurie. I really am grateful for your time this evening. I hope to hear from you. I hope to see you on our website, and I hope to be able to send you a bullish hat in the next few days. And let's stay in touch. Thanks a lot.